Hello to all global viewers and subscribers. This is the story of WorldCom, a company that went from being $100 billion to bankruptcy in just a matter of time. A tale of greed, deception, and a fraud so massive that it shook Wall Street its sport. Let's start off.
The rise and fall of WorldCom, one of the biggest corporate scandals in U.S. history. To begin with, the cost of dishonesty, William Shakespeare once said, "No legacy is so rich as honesty." Yet, in the modern corporate world, many have failed to grasp this lesson. If honesty creates legacies, then dishonesty can utterly destroy them. One of the greatest examples of corporate greed and deception in American history is the downfall of WorldCom, a telecom giant that was once valued at over $100 billion. WorldCom's rapid rise and catastrophic collapse exposed deep flaws in corporate governance, auditing oversight, and Wall Street's obsession with ever-growing profits. But how does a company worth $100 billion crumble within months? This is a story of lies, deceit, and greed that shook the financial world and changed how corporations are regulated today. First of all, let's talk about the birth of WorldCom, a small idea with big dreams. The story of WorldCom begins in 1983 when the U.S. government forced AT&T to break up its monopoly. This decision left a massive void in the long-distance telephone market, opening the door for new competition. Seizing this opportunity, a group of businessmen gathered at a small coffee shop in Hattiesburg, Mississippi, to discuss their vision for a new telecom company. Their idea became Long Distance Discount Service, LDDS, the company that would later be known as WorldCom. One of the men at that meeting was Bernie Ebbers, a Canadian-born entrepreneur with a background far removed from the telecom industry. Before entering the business world, Ebbers was a high school basketball coach and owned a small chain of motels. Despite his lack of experience in telecommunications, he had an aggressive and persuasive personality, which would propel him to the top of the company. By 1985, LDDS was struggling financially, accumulating $1.5 million in debt. The owners decided to appoint Bernie Ebbers as CEO, hoping his leadership could turn things around. And turn things around he did. He focused on strict cost-cutting measures, famously eliminating the company's free coffee policy to save money. Despite such extreme measures, his strategy worked. By 1986, LDDS's revenue had risen to $8.6 million, and a year later, it had nearly doubled to $18 million. His business strategies were very planned and aggressive that brought name, fame, and success to the company. He made many mergers and acquisitions after taking the driving seat. Competition in the telecom industry was fierce, and to stay ahead, Bernie Ebbers turned to an aggressive expansion strategy, acquiring smaller companies. Over the next decade, LDDS acquired over 30 regional telecom companies, allowing it to expand rapidly. In 1995, the company rebranded as WorldCom, a name that reflected its ambition to dominate the global telecommunications market. The biggest and most ambitious acquisition came in 1998 when WorldCom merged with MCI Communications, a company 2.5 times its size, in a deal worth $37 billion. At the time, it was the largest corporate merger in history. The new entity was named MCI WorldCom, and Bernie Ebbers, now one of the highest paid executives in the U.S., became a Wall Street icon. By the year 2000, WorldCom employed 88,000 people, controlled over 60,000 miles of telephone lines worldwide, and reported revenues exceeding $40 billion. Bernie Ebbers, once a modest businessman, had now accumulated immense wealth, including a $400 million loan from JP Morgan to fund his extravagant lifestyle, which included yachts, a yacht building company, and the largest privately owned ranch in the world. As the year 2000 breached, the dot-com crash and desperation both caught WorldCom in hefty bundles unending problems. By the late 1990s, the internet was booming, and telecom companies like WorldCom were riding the wave of optimism. The company planned its next major move, a $115 billion merger with Sprint, which would have made it the largest telecom provider in the world. However, in 2000, U.S. regulators blocked the deal, citing antitrust concerns. At the same time, the dot-com bubble burst, causing telecom stocks to plummet. WorldCom's stock, which had been as high as $62 per share in 1999, tumbled to just $18 by 2000. As revenues shrank and the debt mounted, Bernie Ebbers faced a crisis. The aggressive growth through acquisition strategy had reached a dead end, and now, with WorldCom's stock falling, his personal loans, secured with WorldCom shares, were in jeopardy. Desperate to keep the company afloat and maintain investor confidence, WorldCom's leadership turned to fraud. Now the fraud was about to unleash in front of the world. In late 1999, WorldCom's chief financial officer, Scott Sullivan, received an alarming report from head accountant David Myers. Company profits were vanishing. Sullivan, unwilling to accept the dire reality, repeatedly asked the accounting team to check again. Each time, the numbers remained the same. Rather than report losses, Sullivan instructed Myers to manipulate the numbers. Initially, this involved making small, unauthorized accounting adjustments. But as WorldCom's financial situation worsened, the deception escalated. The company began classifying regular operating expenses, specifically the cost of leasing phone and data lines, as capital investments. Why was this significant? In accounting, an expense reduces profits in the short term, while a capital investment is recorded as an asset and its cost is spread over several years. By misclassifying billions in expenses, WorldCom artificially inflated its earnings, making the company appear far more profitable than it actually was. From 1999 to 2002, WorldCom fraudulently reported over $11 billion in inflated profits, making it one of the largest accounting scandals in U.S. history. Now, here comes the unwanted and perhaps the unexpected entry of the whistleblower. Cynthia Cooper's investigation. The fraud might have continued unchecked if not for Cynthia Cooper, WorldCom's Vice President of Internal Audit. In mid-2002, she stumbled upon an unusual accounting term in the company's records: prepaid capacity. When she asked finance executives about it, no one could explain what it meant. Determined to uncover the truth, Cooper and her team dug deeper and discovered over $3.8 billion in fraudulent accounting entries. When she confronted Scott Sullivan, he dismissed her concerns, but Cooper refused to back down. She took her findings to the company's board of directors, which hired an external audit firm to investigate. Soon, the full scope of the fraud was exposed. On June 25, 2002, WorldCom publicly admitted to falsifying its financial statements. This fraud resulted into the largest bankruptcy in U.S. history. The revelation of the fraud sent shockwaves through the financial world. WorldCom's stock price collapsed overnight, and investors lost a collective $30 billion. The company laid off 17,000 employees, nearly one-fifth of its workforce, in a desperate attempt to survive. But it was too late. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy, listing $107 billion in assets, the largest corporate bankruptcy in U.S. history at the time. Bernie Ebbers was forced to resign, and in 2005, he was convicted of securities fraud and conspiracy. He was sentenced to 25 years in prison, though he was released in 2019 due to failing health. He died a few months later in 2020. Scott Sullivan, the mastermind behind the fraudulent accounting, was sentenced to 5 years in prison. So, ladies and gentlemen, what are the lessons that can be learned from the WorldCom scandal? The WorldCom fraud exposed major flaws in corporate oversight, leading to stricter regulations, including the Sarbanes-Oxley Act of 2002, which imposed harsher penalties for fraudulent financial reporting. The scandal remains a cautionary tale about unchecked corporate greed and the dangers of prioritizing short-term stock performance over ethical business practices.
So guys, that's all from this video. Just imagine, how did one of the biggest telecom companies in the US commit one of the largest accounting fraud in history? And how did it all come crashing down? The collapse of WorldCom was not just about numbers on a balance sheet, but it was about broken trust, ruined lives, and the dark side of the corporate ambitions. Bernie Ebbers went from being a Wall Street hero to disgraced CEO. Thousands lost their jobs, billions vanished, and investors were left picking up the pieces. But here is the real question. Are there other WorldComs out there today, even companies hiding their financial skeletons until it's too late? Could any another scandal like this hit once again anytime in the near future? So, guys, if you have found this story eye-opening, make sure to like, subscribe, and turn on notifications so you don't miss our next deep dive into history's biggest business scammers. And if you are ready for another shocking case, check out our next tutorial. Till then, stay blessed. Thank you.